Hi, everybody. I think in the interest of time, we're going to make a start. So good morning and welcome to this morning's K3 Hub Structured CPD session. My name is Marie Wadeson and I'm a Managing Director here at Quantuma. And on behalf of our parent company, the K3 Capital Group, I lead the K3 Hub, which is a member network where we proudly have over 2,800 members, and our members can access a range of CPD and training sessions not dissimilar to today's event, as well as referral fees for certain types of work referred into our group. Just to cover off, our group offers a wide range of niche advisory services, including restructuring, corporate finance, forensic accounting, R&D tax credits, and marketing services for professional services firms. Moving on to a little bit of housekeeping just before we get going. You will have noticed we are recording today's session. It will be placed onto the K3 Hub website next week, and you'll be able to refer back to that at your leisure. We are going to post the slides in or today's presentation, in the chat. I can see that the team in the background have just done that. We will do that periodically throughout the session for those people who join slightly later. One thing to flag, we've had a fairly overwhelming amount of questions up front for Malcolm, today's speaker, who is always extremely popular with us. I anticipate that a lot of those questions we are going to cover the responses to during the course of the session. But I'm conscious also that Malcolm has an awful lot of sort of technical content to get through today. So whilst we do welcome sort of your succinct questions in relation to the slide being presented, we're not necessarily going to be able to get to every single sort of last question that sort of looks to delve deeper into a specific client issue or circumstances. We're conscious that today is a 3-hour session, and therefore we are planning some breaks. They'll be there or thereabouts on the hour. So it brings me great pleasure to welcome back Malcolm Greenbaum, who is a regular speaker here at the K3 Hub. This is Malcolm's third session this year, and he always proves probably one of our most popular speakers. He's run 2 sessions on VAT this year so far. He's a qualified chartered accountant and chartered tax advisor. He worked for BPP for 18 years prior to setting up his own training and consultancy company in 2008 even, where he delivers accounting and tax courses to accounting firms and clients across a wide range of industries. In today's session, Malcolm will broadly cover common issues with adjustments to profits, annual investment allowance versus full expensing, relief for losses, common loan relationship issues, and hybrid mismatch and common scenarios. Just a flag before we get going that there are a few more K3 Hub sessions this year that I wanted to bring to your attention. So 1st of December, we've got another CPD session. That's tax for non-tax specialists, and that'll be delivered by another one of our very popular speakers, Jeremy Mindell. And on the 24th of November, we'll be running an autumn statement webinar. And again, that'll be Jeremy that's running that. So that's everything that I've got to say. So I will hand you over to Malcolm now and wish you all a great weekend when it gets there.
Thank you very much indeed, Marie. A very good morning to everybody. Welcome to this session, which deals with certain aspects of corporation tax and hopefully areas which will be common to many of your clients. As Marie said, I'm going to cover quite a lot of ground today. I hope to cover quite a lot of ground today. And as such, there won't be an awful lot of time to answer specific queries. And this isn't a consultancy surgery, so I'm not looking to answer specific client queries. But as Marie said, if we're covering a particular technical area and you have a question about that technical area, then by all means put it in the Q&A and I will see it very quickly. I've got it on a separate monitor and get round to it as soon as I can. Also, as Marie said, we'll stop a couple of times this morning for breaks. I reckon that about 50-55 minutes is about the maximum time that you can probably concentrate on a screen without going mad. So we'll stop roughly on the hour to have a 10-minute break to get some caffeine and just get away from the screen for a few minutes. Let your brains cool down before we go again. Now, we're going to start by looking at recent developments in corporation tax, principally those that have been legislated in the Finance No. 2 Act, which got royal assent back in July. We'll look at some common issues around adjustments to profits, which I often have to give advice on and around. As Marie said, we'll look at the new capital allowance, which is now available for companies from the 1st of April this year, which is colloquially known as full expensing. It's essentially a 100% first-year allowance, and it's on an unlimited amount of relevant expenditure, unlike the AIA, the annual investment allowance, which has a £1 million per annum limit. And what I want to do is talk around, if you had a choice between claiming one or the other, because you could claim AIA, you could claim full expensing, which one would you generally choose? We'll talk about relief for losses, both old losses and new losses. Some common loan relationship issues. Again, I've chosen topics where I've had to give advice to a number of firms of accountants about how you treat certain things. So these are commonly arising issues. And we'll finish up by looking at something called the hybrid mismatch rules. These were introduced way back in 2017. I don't think many people took them very seriously until about 2019, 2020. Thereafter, people realized that there's a lot of work to do to establish whether there might need to be a disallowance of expenditure on the basis that it gives rise to some kind of mismatch where the payer is claiming a deduction and the recipient is not being taxed on it, or alternatively, where there's a payment to a third party where the expense might be claimed once in the UK and again in an offshore jurisdiction, a so-called double deduction. And I want to talk around the common scenarios where we have to think about whether a disallowance would operate or not. The most common scenario is where you'll be acting for a UK subsidiary of a American parent company, or alternatively, if you're acting for a UK branch of a foreign company. Those are the two most common areas where disallowances can potentially arise. So let's crack on and have a look at recent developments in corporation tax, particularly those that were legislated in the Finance No. 2 Act on the 11th of July this year. Well, we know now that the 25% rate, which took effect from the 1st of April this year, where your profits are above 250 grand, although the 19% rate continues where your profits are below 50 grand, those rates and those profit limits are not going to change next year. They're going to stay the same from the 1st of April 24 as well, although, of course, we are expecting a general election towards the end of next year. And there's been a lot of campaigning to reduce this rate of this 25% rate as soon as is possible, because it's felt that it is damaging the UK economy. So this is where we stand at the moment. But obviously, in the event of a general election, particularly the change of government, that could all be up in the air for change. When it comes to R&D relief, this is the area where there have been most changes going forwards. The Finance No. 2 Act confirmed that the specific area of pure mathematics can qualify as R&D expenditure. I always thought that pure mathematics, I studied pure maths at school to what's called S-level standard. I always thought that was kind of the end of maths, but apparently they keep creating new maths along the way. So new mathematical techniques can qualify as R&D. And the restriction of R&D relief to UK expenditure, which was planned to come in from the 1st of April this year, got postponed by a year to the 1st of April next year. So at the moment, we can still claim R&D relief for relevant expenditure anywhere in the world. The one thing that did change quite significantly, and in fact, although it was going to be from the 1st of August, it ended up being from the 8th of August, but that's a bit of a moot point now, we're past that date, is that in making a claim for R&D, you now have to provide an awful lot more information than you had to in the past. And the idea of that information form is to try to ward off any spurious claims for R&D. Because when the relief was first introduced, certainly HMRC accepted all kinds of claims because the government wanted to say that it had been a successful new piece of law, but many of those claims were ludicrous. They weren't R&D in any sense of the word or phrase, and that has unfortunately continued to the present day. So to try to wheedle out claims that really shouldn't be getting R&D relief, you're now required to take it much more seriously and provide much more information, which we'll look at very shortly. When it comes to SME relief, the government announced that from the 1st of April this year, they were reducing the rate of SME refund for enhancement expenditure that then leads to a tax credit repayment from 14.5% down to 10%. And what they've now decided is that if your SME client is R&D intensive, it will still be able to get a repayable tax credit at 14.5%. And R&D intensive for these purposes means that the qualifying R&D expenditure for the accounting period is at least 40% of the total expenditure, the total essentially operating expenditure in the P&L. And companies will have to indicate on this new information form, this additional information form, if they are actually claiming as an R&D intensive company or not. They'll tick a box on that form. Something which isn't mentioned in the law at the moment, but there's a consultation going on at the moment, is the merging of the SME scheme and the RDEC, Large Company R&D Expenditure Credit Scheme, into a single scheme. And it now seems almost certain that that new singular arrangement will kick off from the 1st of April next year. What we do know is that it will be an expenditure credit. So instead of claiming a tax adjustment as an enhancement of expenditure purely in the tax return, going forward, there'll be some sort of expenditure credit idea, so that if a company spends 100 grand on R&D and the rate of expenditure credit will be, say, 20%, then they'll actually book an entry in their P&L for income of 20 grand, 20% of the 100 grand R&D spend. So the company will actually book profit in its P&L, pre-tax profit of 20 grand. That will then be subjected to corporation tax at whatever rate applies to that company, bizarrely. So this is a sort of made-up book entry, credit P&L income, debit tax recoverable, but the credit is subject to corporation tax. But the debit for the tax recoverable means that any liability that then arises would then be covered by this amount of tax recoverable that's been debited. So SMEs will have the same kind of scheme as large companies, although we don't know yet whether there'll be a different rate of credit than there is for large companies. At the moment, large companies get a 20% credit, used to be 13%. We're not quite sure what's going to happen with SMEs yet. We'll probably find out later this month. In fact, Jeremy may pick up that with you if you log into the autumn update session. Now, the big change, as I mentioned, is this additional information that you now have to provide. Now, in the first instance, if your client hasn't actually made an R&D claim in the previous 3 calendar years, so HMRC is not used to dealing with an R&D claim from your client recently, then you actually have to give advance notice to HMRC that you intend to make an R&D claim in your corporation tax return, in your CT 600. And you have to tell HMRC that you're going to make this claim within 6 months of the end of the set of accounts finishing in which that expenditure relates. Just to remind you that the tax law uses different terminology. It uses period of account and chargeable accounting period. The only time that they're different is where the period of account, the set of accounts, is more than 12 months long. Because a period of account which is 18 months long creates 2 chargeable accounting periods, the first 12 months and then the other 6 months. So this is saying that if you produce a set of accounts which is 18 months long, you've got up to 6 months after that to notify HMRC that you intend to make an R&D claim. That notification that you're going to make a claim has to contain the company's UTR, the contact details within the company of the main person dealing with the R&D claim, the contact details of any agent which is going to be involved in the claim, and that could be more than one agent. If those agents have a reference number which the company is aware of, that reference number, and it must list the start and end of the period of account, the set of accounts, and also the chargeable accounting period, start and end dates of the accounting period for which they're claiming R&D relief. So if the client has produced an 18-month set of accounts, but all of the qualifying R&D relief sits in the second 6 months, then what they'll say to HMRC in this notification is, we've got an 18-month set of accounts, it starts here, it ends here, but the R&D claim is only in the 6-month period of accounts from this date to this date. So HMRC knows exactly what to expect when the full return is delivered. Now, when you deliver that return, you have to provide this additional information for the R&D claim itself, and there's a lot of it. So we have to show the UTR of the company. Well, that's not unusual. We have to show the employer pay-as-you-earn reference number. And I think the reason for that is simply it just makes it easier for the corporation tax teams at HMRC to cross-check the amount of pay-as-you-earn and NIC that's been accounted for the accounting period, because that can affect the maximum amount of credit that can be refunded to the company. You also have to declare the VAT number of the company. I've got no idea why that's relevant. It should play absolutely no part whatsoever in the claim, but they want the VAT number as well. Then again, the contact number of the main person at the company dealing with the claim, because that may have changed since you notified that you were going to make a claim. The person who was dealing with it might have left and someone else may have come along. You have to quote the SIC code, the standard industry code for the type of business which the company is involved in, and that's to focus HMRC's attention on where the biggest risk of a false claim lies. Because whilst HMRC accepts that virtually any industry could have a claim, a valid claim for R&D, it knows from its past experience which type of industries there have been fraudulent claims made. So it's a bit of a risk assessment with that code, but a lot of codes are meaningless. I think our company code is other services not listed elsewhere. Doesn't really tell you anything. If an agent is completing this additional return, then the agent's reference number, and you must list all of the contact details of any agent that worked on the claim. That could be an R&D specialist who provided input as to whether the R&D qualified, and it could be you if you are the one who is preparing this return. So it could be more than one agent. The chargeable accounting period start and end date, which obviously should marry with the CT600 dates, and then the qualifying expenditure broken down between the different categories of qualifying expenditure under the law. So broken down into qualifying employee costs, externally provided worker costs, contracted out R&D, software costs, consumables, payments to participants in a clinical trial, and then the latest ones added to the list, the cost of data licenses for acquiring data which is for exclusive use in an R&D project, cloud computing services, and contributions to independent R&D costs if you are a large company. Having listed all those qualifying expenditures and then added them up, you then have to tell us, or tell HMRC, the amount of those total expenditures which are qualifying indirect activities. And HMRC is going to look at the ratio between the qualifying indirect activities and the total qualifying costs to see whether that looks reasonable or whether it warrants further investigation. We have to list the number of projects that we're claiming for, so how many projects this expenditure relates to, and probably most onerously, unless you've already got a detailed report from an R&D expert about the ability of this project to qualify for relief, you have to describe the projects that you've undertaken. So you have to answer the question about what is the field of science or technology for which the R&D project relates. What was the baseline level of technology that the project was intended to advance? Because it doesn't actually have to advance it. Failed R&D is still qualifying R&D. As long as you sought to move the baseline to create something which hadn't been thought of before, then that's fine if you don't actually achieve it. So you have to answer the question, what advance did you seek, did your client seek to achieve? And what uncertainties did they face in trying to achieve that? And in formulating the project, how did the project seek to overcome those uncertainties? So those questions essentially deal with the definition of qualifying R&D. And an R&D specialist would know that this is the information that HMRC is looking for, and they will be able to tell your client whether their project could fall within these headings, and they would write a report for your client. So if they've written a report for your client, copy and paste it, stick it in this return. If your client hasn't taken independent advice over whether the project qualifies, they're going to have to fill all these things in themselves from scratch. And as I say, it's supposed to act as a deterrent for those people who are making spurious claims, because they won't be able to answer these questions. Now, if during the relevant chargeable accounting period, your client has undertaken up to 3 projects, then they have to describe all 3 projects under these 5 headings. If they've undertaken during the chargeable period 4 to 10 projects, then they have to describe projects that at least account for half of the total qualifying expenditure. And in any case, they must describe a minimum of 3 projects. And if, amazingly, they've undertaken more than 10 projects in the accounting period, then again, they have to describe all projects that account for at least half of the qualifying expenditure, again with a minimum of 3 projects described. But if the qualifying expenditure is spread fairly evenly, perhaps across all of the projects, then they have to describe the 10 largest projects under these 5 headings. So your clients mustn't underestimate the amount of work that's going to be needed going forwards to make an R&D claim. The information return also has to disclose the number of externally provided workers who worked on the projects. You've already told them what the cost of those workers was, so tell them how many people worked on the project and give the pay-as-you-earn scheme reference number for those externally provided workers, so that HMRC knows those workers have had pay-as-you-earn deducted from their pay somewhere along the chain. So that's the information that needs to be provided, and you can provide that information at the same time you file the CT600, or you can file it before if you so desire. I imagine that in practice we'd file it all at the same time. Now, when it comes to capital allowances, I mentioned before this new relief, this so-called full expensing relief, which is a 100% first-year allowance. It only applies to companies. It doesn't apply to unincorporated businesses, and it only applies to qualifying plant and machinery expenditure from the 1st of April 23 at the moment until March 26. The government has said that it wants to make this change permanent when it's economically responsible to do so. It would be very helpful if they did make it permanent, because that then gives companies some sort of certainty about the future tax landscape. Now, there's no limit on the amount of expenditure that can qualify. So it has an advantage over the AIA, which caps the 100% relief at £1 million a year. So very large businesses, very large companies that spend a lot of money on capital projects every year, they can now qualify. So in essence, this is only going to really benefit those companies that do spend more than £1 million a year. Because if you spend up to £1 million a year, you've got the AIA available already. And the qualifying expenditure, excuse me, is the same as the qualifying expenditure for the 130% super deduction that finished on the 31st of March this year. So the expenditure of the plant and machinery, has to be new and unused, and it mustn't be used in a way that it's leased out. And the definition of leasing for this purpose is very, very broad indeed. And last week, I dealt with a consultancy query where there was a holding company and it had a trading subsidiary. And I asked, and apparently it levies a management charge to the trading subsidiary to cover the costs it incurs. But it's the holding company that bought or buys all of the plant and machinery. It's the trading company that uses it, but it's the holding company that buys it. I don't know why, but that's the situation. So if the holding company is buying the plant and machinery, a subsidiary is using it, and it's being charged essentially for that usage so that the holding company can recover its costs, then that expenditure by the holding company did not qualify historically for the super deduction, and it won't qualify for this new 100% full expense allowance. Because HMRC would say, and they'd be correct to say, that in the definition of leasing in this part of the Capital Allowances Act, that is leasing out plant and machinery. So it doesn't have to be a formal lease at all. It can be another group company using the asset. That will count as a lease arrangement. Now, when you sell later an asset on which you will have claimed this 100% full expensing allowance, then the proceeds will always create a balancing charge, because you essentially don't pool this asset into the general pool. It has a standalone 100% allowance, and that's it. So it's kept out of the pool, so that when you sell the asset, because it's depooled, the proceeds automatically give you a balancing charge. Now, that fact ordinarily means that given the choice between claiming AIA and claiming the full expense allowance, the AIA would be preferable. If we don't need the AIA to cover other assets, for example, assets that would otherwise go in the special rate pool, then we should claim the AIA in priority to the full expense allowance. Because with the AIA, the proceeds are deducted from the pool balance on disposal. And if the proceeds don't create a negative balance on the pool, then whatever positive balance is left just rolls forward with an 18% writing down allowance. We don't get a balancing charge. So I said at the beginning, we'd talk about full expensing versus AIA. If you don't need the AIA for any other purpose, so for an asset that wouldn't otherwise get 100% relief, then use the AIA in priority to full expensing. And there'll be different boxes on the corporation tax return to complete for whichever relief you're claiming. At the same time that the government introduced this 100% full expensing for plant and machinery, they announced that the 50% first year allowance, which was put in play from the 1st of April 21, when super deduction first came along, that was going to expire on the 31st of March 23, but it's been extended for a further 3 years. And just a reminder that if you claim this 50% first year allowance for special rate pool expenditure, which is principally going to be features which are integral to a building, things like lifts, escalators, air conditioning systems, electrical wiring systems, lighting systems, and so on, then when you dispose of these assets, having claimed a 50% first year allowance, when you dispose of them, 50% of any proceeds will create a balancing charge. The other 50% will be deducted from the special rate pool, the pool on which you claim 6% writing down allowances. Now, as I say, the government said it's aiming to make it a permanent change. That's an interesting statement to make, because they've already said that it's going to go out till March 26, and we have a general election next year, towards the end of next year, probably autumn next year. So it's a pretty brave claim to say they're going to make it permanent when we can, because they really only have until the next general election, I think, to make it permanent if they wish to do so. And if there is a change of government, the new incoming government could just abolish it anyway. So although it's said to be semi-permanent, I would more consider this to be a window of opportunity until at least the next general election to claim these 100% or 50% reliefs, because I don't know what's going to happen after that election. Now, the government also made a lot of changes to corporate interest restriction. To be honest, we could spend a minimum 3 hours just on this one topic. But if you do deal with either standalone companies or groups of companies where the UK companies in aggregate have interest expense for tax purposes, which is more than £2 million, then they would have to consider the corporate interest restriction legislation, which is in part 10 of TOPA 2010. The problem with that legislation is it tries to mix together tax adjusted information and broadly accounting information. And when you try to mix those things together, you always get anomalies. And the government then spends every Finance Act thereafter clearing the anomalies that have become apparent since the last Finance Act. It happened with this legislation's predecessor, the worldwide debt cap, and it continues to happen every single year for CIR. The amendments they've made are principally to make sure that the law works in the way that was always envisaged by the government. But based on the wording of the legislation, some companies have applied a different interpretation, which seems perfectly valid based on the words. So the words need to be tightened up to make it clear what they mean. Now, the sort of thing that they've done is to tighten up the wording so that if there's an internal reorganization of a company and a new holding company is inserted partway through the year via a share-for-share exchange, it makes it clear that any group level carry forwards, like unused interest allowance carried forward, can be carried forward by the new holding company. Because generally speaking, when a group ultimate parent company is no longer the ultimate parent company, there's a takeover by another company, then all of that old group's brought forward group balances just get written off. They don't exist anymore. And we base all the calculations on the new group that they've joined. But it's always said that if there's some kind of internal reconstruction, then carry forwards are allowed, but it didn't specifically cater for a reorganization partway through a chargeable accounting period. So what it does is create a notional period to the date of change and then a period thereafter, and says anything up to the internal reconstruction date, anything that's accumulated gets carried forward to the second part of that period, if you like. It also makes some clarification as to what's included in tax adjusted EBITDA, and it tries to reduce mismatches between what's included in the figure of tax interest expense and what's included in group interest expense, ANGI or QUANGI, as some of you may know them. Now, in most cases, in fact, in virtually every case involving these amendments, any changes they've put in place don't take effect until periods of account that start on or after the 1st of April this year. These changes don't affect your calculations, for example, for the year ended December 23. They'll affect that company for the first time, if they're going to affect them, in the year ended December 24 onwards. Now, there's only one change which I think is of potential significance, which is something called equity bonds. If a company issues what are called equity bonds, those are bonds that pay interest, but they're either not redeemable, they're either irredeemable, or if they are redeemable, the latest date of redemption is after 50 years. It's more than 50 years after they're issued. Those are called equity bonds. They're defined in, I think it's CTA 2010, Corporation Tax Act 2010. And the CIR legislation has always used the definition in CTA 10, 50 years. And so what it says is that if a company issues equity bonds, then the interest on those bonds is actually treated for corporation tax purposes as a distribution. It's not counted as interest expense for corporation tax purposes. But the CIR legislation, when it picks on a figure called ANGI, adjusted worldwide net group interest expense, because that's an accounting number, And because the bond interest is accounted for as interest in the accounts, it's always been included in this ANGI figure, but it's always been removed in arriving at a figure called QUANGI, which is used when you're working out something called the group ratio method of interest allowance. So it was always in ANGI and taken out of QUANGI. Now, what they've done is change the law to say that for CIR purposes and CIR purposes alone, the definition of an equity bond is now, for periods beginning from 1st of April this year, any bond which is irredeemable, or any bond where the latest redemption date is more than 100 years after it's issued. So they haven't changed the definition in CTA 2010, they've simply changed it for the purpose of the CIR calculations. So now, if a company issues a bond which is redeemable in 75 years' time, then that is an equity bond for corporation tax purposes. So the interest is disallowed for corporation tax purposes, but it's not an equity bond for CIR purposes. It's a regular bond, which means that the interest, which is recognized in the group P&L for these bonds, is included in this figure of ANGI, and it's included in this figure of QUANGI. It's not removed at any stage, despite the fact that the interest expense itself isn't tax deductible. It's treated as distribution and therefore isn't included in what's called the net UK tax interest expense. So it's not a tax deductible figure we're seeking to claim relief for, but the interest still forms part of ANGI and QUANGI, which therefore increases the overall interest allowance the company will probably get for that period, the maximum amount of interest that it can deduct under the CIR rules. That's a very strange change, and I haven't yet quite got to grips with why they thought it was necessary to do that. This probably won't affect many of your clients, because this change only affects groups of companies that have consolidated revenues of more than 750 million euros. It's in euros because it's based on OECD limits, which are always quoted in euros. Now, the idea is that if your client is a large, very large group, and there are transactions taking place within the group, that the companies must maintain a master file and a local file detailing their transfer pricing policies and their transfer pricing calculations in accordance with OECD guidelines. Now, I have to tell you that most groups that have revenues of above 750 million euros are almost certainly already doing this, because they would have needed it for years to comply with other jurisdictions' tax laws. So it's not as big a change as it might sound. And for companies, they only have to introduce this system in the UK for accounting periods that commence from the 1st of April. And they don't have to send HMRC copies of their master file and local file records. But if HMRC requests them, they have to send those records to HMRC within 30 days. And HMRC says it's going to be issuing questionnaires about the audit trail which the group uses in determining its transfer prices. Because then it can focus, HMRC can focus its efforts on those areas which it perceives to be of highest risk. Those companies that don't seem to have a very rigid audit trail, a proof of how they've arrived at their transfer price, or they have, but their transfer price is based on taking the overall profit across the whole supply chain and then trying to divvy it up amongst different divisions, because that's always very subjective. So those are the main legislative changes that were incorporated into the Finance No. 2 Act as they affect companies. There have been other developments in corporation tax, which I think you ought to be aware of. So HMRC has been spending a lot of effort investigating loans where they believe those loans have an unallowable purpose. Now, this area is only covered in two sections of the legislation. Section 441 and Section 442 of CTA 2009, the Corporation Tax Act of 2009. And it says that if a company is a party to a loan relationship for an unallowable purpose, then its loan relationship debits, its expenses for that loan, are disallowed. It then says an unallowable purpose is one which is not a business purpose of the entity. Not very helpful. But then it says that means that either the loan that's been raised, the money that's been raised, is not used within any activity which is subject to UK corporation tax, or the company is a party to a loan relationship for a tax, where one of the main purposes of the arrangement is tax avoidance, gaining a tax advantage. So if gaining a tax advantage is a main purpose, then HMRC can disallow the interest expense. And the sort of cases that are coming before the courts, which HMRC at the moment is winning, involve situations like this. You've got an American group that wants to buy an American competitor. So what's that got to do with the UK? Why don't they just go and buy it? But oh no, they structure this acquisition using a series of 9 separate transactions, which itself would attract the attention of HMRC to the extent it involves a UK entity. What it did, they created a newly formed UK company called JTI Acquisition Corporation. They allowed that company to issue $500 million worth of loan notes to its immediate US parent. That would then ordinarily create interest expense for the new UK company, which the group was then going to claim as a non-trading loan relationship deficit. And it was going to group relieve it. It did group relieve it to other entities, to other UK group companies. The immediate US parent assigned the loan notes to a Cayman company. Well, that means that the interest income in the Cayman Islands would not be taxed. And the company originally applied to HMRC to ask them for advanced assurance, clearance, that HMRC would not seek to invoke what's called the thin capitalization rules. That's part of transfer pricing within the tax legislation. And what it means is that HMRC can look at an amount borrowed from a connected person and determine whether that borrower could reasonably have borrowed that amount from a third party on the same terms. And if HMRC would judge that the company would not have been able to borrow the same amount from a third party, let's say they would have been able to borrow 40% of that amount, but not 100%, then HMRC can invoke the thin capitalization rules and say, well, if you were seeking ordinary external finance, only 40% of what you raised would be debt finance. You'd have to raise the other 60% as shares, as equity. So it gives HMRC the chance to treat 60% of the actual interest incurred by the borrower as if it was a distribution relating to a 60% equity holding in the company. HMRC came back and said that they weren't going to raise any issues around thin capitalization. So the group thought, that's okay, then we'll claim the interest as a deduction and we'll group relieve it to other UK 75% group companies. But HMRC then later contended that the interest should be disallowed as being for as relating to a loan that's for an unallowable purpose. In other words, the main purpose, or one of the main purposes of JTI Acquisition Corp borrowing the money was to create tax savings. The first tier tribunal said, yep, we can see that the UK company got a tax advantage, not directly, but indirectly through group relieving that loss to other UK companies. The UK company didn't really have any great decision-making powers. It was told what it would be doing. You will borrow, you'll issue $500 million dollars in loan notes to the parent company, and you'll surrender whatever loss that creates in your accounts. So the first tier judge said that the objective seemed to be, at group level, to obtain a tax advantage through a loan relationship. The group's contention, or rather JTI Acquisition Corp's contention, is, well, the whole thing here has a commercial purpose. The group wants to buy a third-party company, wants to buy a competitor. So once we've established that the reason for what we're doing is a third-party purchase, HMRC should not be able to then say that any part of the structuring of that deal, has a main purpose of tax avoidance, because the main purpose is the third-party acquisition. And essentially the group is saying we're entitled to structure it in what we consider to be the most tax efficient way. But the judge rejected all of the business or commercial purposes why the UK company had to borrow money. The judge said there seems to be no purpose to borrowing money apart from to gain a tax advantage, and therefore confirmed HMRC's decision to disallow all of the interest expense of this UK company, which meant there was nothing to group relieve to any other company. So the group, or rather the UK company, appealed that decision to an upper tribunal, which has recently given its decision. The group was still arguing that once you've established that there is an acquisition on the table, and therefore there's a commercial purpose to these transactions, then you shouldn't go investigating every single sub-transaction that achieves that objective. So where the company was borrowing at an arm's length price, and HMRC had confirmed that it didn't have any problems from a transfer pricing perspective, then once you've established that the commercial purpose is ultimately to buy a third-party company or group, there can't be an unallowable purpose. So HMRC was arguing that the only reason why that company was created was to create a tax deduction. It seems to have no other purpose whatsoever. So the upper tribunal quoted legislation, said, look, these pieces of legislation, these two sections, they're anti-avoidance rules. There's no way that anti-avoidance rules would be drafted very, very narrowly. They would be drafted to cast the net as widely as possible. And therefore, the judge preferred HMRC's interpretation of those sections, which took account of all facts and circumstances, rather than just saying, well, the group is looking to buy a third party, so that's commercial, so everything we do is commercial. And whilst the first-tier tribunal had made some errors in connection with what are called related transactions, so not the direct loans themselves, that wouldn't have changed the ultimate decision. There were no errors which were material to their decision, and so the upper tribunal confirmed the first-tier tribunal's disallowance of the interest. Now, what you need to look out for are situations where you're acting for a UK company which has been required to borrow money, not for its own purposes directly, but for a purpose outside the UK. Because it might well be that in that situation, the main purpose of getting that UK company to borrow money was to create an interest expense, which would be tax deductible in the UK. HMRC would disallow that if they inquired into that situation. Now, cap allowances. This case predates structures and buildings allowance, the 3% structures and buildings allowance. So back in the day, either you had plant and machinery, which qualified for cap allowances, or you had expenditure on structures and buildings, which simply did not qualify for any allowances. And so this case has been rumbling through the courts for many years now. And whilst it specifically relates to a hydroelectric power station, the principles are what's important here. Because going forwards, although we now get an SBA, a structured buildings allowance, it is only 3%. And now we have this 100% full expense allowance. If the item is not structures and buildings expenditure, it's plant and machinery expenditure, then it can qualify for 100% relief immediately. So it makes a massive difference to the tax you can save. So, as I said, the company in question is trying to claim that expenditure it's incurred is plant machinery in connection with a hydroelectric power station. Now, the way that these power stations work is that they are located on or very close to a body of water, probably in a body of water, and the water is pushed through what the company says are pipes, which creates pressure so that the water goes through a turbine at high pressure and it spins the turbine round. Just imagine like a jet engine on an airplane being spun round at very high speed. That creates energy. And that energy can be converted into electricity and power as an output. And then once the water's passed through, it has to have an escape route so that the water behind can continue to flow through the turbine and keep it spinning. Because once the water starts flowing, the turbine will slow down and ultimately stop. So HMRC said, well, the structures that get the water out of the reservoir of water into the turbine and then out of the turbine and away, they are either tunnels because they're under the water, or they're aqueducts because they are structures that carry water. And tunnels and aqueducts are given as examples of structures. Okay? Examples of structures. So back in the day, they would not have qualified for cap allowances. So essentially the company is saying, no, it's pipe work, it's plant and machinery, and HMRC is saying, no, they are tunnels, or alternatively, they are aqueducts. Whichever way you cut it, they are structures that don't get any cap allowances. So the Supreme Court has now decided, so there's no going any further, this is it, that within the legislation, this is section 22 of the Cap Allowances Act, structures are listed thematically. So there are groups, or there are items which have a group of definitions or nouns, rather, within them. So item 1 on the list of structures which don't qualify for plant and machinery allowances, it says tunnels, bridges, viaducts, aqueducts, embankments, or cuttings. That's it. That's what it says. So the question is, are these just different things, or are they part of a theme? And the Supreme Court is saying they're part of a theme. This is thematic. And therefore, these are all structures that relate to the construction of transportation routes or ways. And you have to read them in context that they are grouped together. So when you read the word tunnel with the other words in this item, so with the words bridge and viaduct, then in the Supreme Court's opinion, a tunnel is best described as an underground passageway which allows you to gain access from one place to another for persons or means of transport. So train tunnels, car tunnels, bus tunnels, subways for pedestrians. That's what's meant by a tunnel. It isn't a structure that's designed to carry water. So these pipes that have been constructed to get the water to the turbine and out again, they're not tunnels. So the next question is, are they aqueducts? So the Supreme Court said, well, the word aqueduct is listed immediately after the word bridge, bridge and viaduct. And therefore the theme seems to be bridge-like structures that carry things. So a viaduct is a bridge-like structure that you can walk across or transportation, can pass across. And therefore an aqueduct must mean a bridge-like structure that carries water from one source to another. And therefore, because these pipes were not elevated, in fact, they were subterranean, they were under the water, they weren't aqueducts either. So after many, many years of fighting, it's been confirmed that these pipes can neither be considered to be tunnels nor aqueducts, and therefore they do indeed qualify for plant and machinery capital allowances. Now, when they were incurred, there was no full expensing. So perhaps £1 million or whatever the AIA was at the time would have qualified for 100% relief. But otherwise, they'd be looking at a claim for 18% writing down allowances per annum. So whilst you will almost certainly never deal with high, court has laid down principles which we can now use if HMRC tries to come back to our clients and say, we don't believe your expenditure is plant and machinery because we believe it sits in item 1 or item 2 or item 3 or item 4 of section 22 of the Cap and Ants Act. We can then look at that and say, right, okay, so the Supreme Court has said these things are all thematic. So there's a theme that runs through them. Do we believe that HMRC could argue thematically that these items are structures or not? So it's actually a very important case. Then we have the case of M Group Holdings Limited. Now, don't be fooled by the name. M Group Holdings was a single company. It was not part of a group at all. And it was a service provider to the NHS, and the owner wanted to sell the company's trade. But buyers didn't want to buy the trade and assets because that's messy. Company, because they were concerned about the history of that company that they would inherit. Now, in that situation, we always tend to recommend that you hive the trade down to a new company, a new subsidiary. You can transfer all the assets at no gain, no loss. You can transfer any inventory or stock broadly at cost. And if the trading company had losses, you can transfer the losses to the hive down group company with the trade. And then you've now got a brand new company with the trade and assets inside it, and a buyer can now purchase that new co. The question here is whether the disposal by the company of the new co normally, if you're looking to hive down because you want to sell to a third party, the sale to the third party would take place pretty quickly after the hive down. It was entitled to SE, and HMRC said that it wasn't. SSE, you have to hold at least 10% of a trading company as a corporate shareholder for at least 12 months out of the previous 6 years. And HMRC says, well, you've only owned the subsidiary for 11 months. So the company says no, because there's an exception to that 12-month rule contained within paragraph 15A of the schedule that deals with SSE, Schedule 7AC of the Taxation of Chargeable Gains Act. It says that the ownership period, the actual ownership period, is extended where you've transferred trade assets to an investee within the 12 months before disposal. But it states quite categorically that you can only extend it for the period that the transferor ran that trade, if the transferor ran that trade while it was a member of a group. It actually says that, while it was a member of a group. And HMRC says, but M Group Holdings Limited wasn't a member of a group when it ran the trade. It created this new co and then hived it down. So it can't have this SSE relief. The first tier tribunal had already denied relief, and the company appealed to the upper tribunal, saying, first of all, we think you can have a group of just one company. So M Group Holdings should be considered to have been a group when it ran the trade, and that's just a nonsense. That the aim of the legislation was to apply SSE where the trade had been owned by 12 months, irrespective of the corporate structure of the group. And probably the most interesting argument worth hearing is that the law would discriminate against a standalone company compared to a company that already had a dormant subsidiary in place. So if M Group Holdings had a dormant subsidiary in place, then while it was trading with the business, it was a member of a group, it and dormant subsidiary. And so if it later transferred the trade to that dormant subsidiary, or indeed just created another company and transferred it to it, then the time limit would be extended because the transferor was running the trade while it was a member of a group, just a group of it and a dormant company. And to be fair, if that is correct, then the law is stupid. If you can take advantage of the law by just having a dormant subsidiary sitting there, then the law really isn't good. It's not good law. When it went to the upper tribunal, it said group has an ordinary meaning and everybody accepts that a group is more than one company. The law is pretty clear that the extension of the time limits can only arise in very limited situations, and that's where the transferor was using the assets in a trade while it was a member of a group. That wasn't the case here. And as far as the court was concerned, there was no mistake by Parliament, because if Parliament had meant it to apply to anything other than groups, it could have said so, but it clearly didn't. So the advice, just before we stop for some coffee, the advice has to be that if you have a client company where there's any chance whatsoever that they will dispose of the trade by hiving down the trade to a new company and then selling the new company, that client should set up a dormant subsidiary immediately. Because then it will be trading while it's a member of a group. And if it hives down and sells that hive down company 3 months later, as long as it has been running that same trade that was hived down for at least 9 months while it had that dormant subsidiary there, it's going to qualify for SSE. So not only is any gain on the disposal of the hive down company exempt, it means that if any assets were transferred at no gain, no loss, and have now left that old group within 6 years, it means that degrouping gains that would otherwise have arisen will similarly be exempt from tax. So whilst it is ridiculous that setting up a dormant subsidiary is necessary in order to try and take advantage of paragraph 15A of this legislation, if that's what it takes, then that's what we should do. And it would come at a cost of £13 a year for the confirmation statement for that dormant company. It wouldn't need to file accounts, it wouldn't need to file tax returns because it's dormant. So have it sitting there just in case you want to use it as a hive down vehicle to then sell the business sometime later. Okay, we'll stop for our first coffee break at this point. Let's come back in 10 minutes time. So I'm at that 10:15, and we'll start when we come back by looking at some common issues around adjustments to profits. Okay, let's continue, please. Let's move on to some common issues around adjustments to profits, where I often find that there is uncertainty, at the very least, on how to treat things. First of all, when it comes to capital expenditure, capital versus revenue expenditure, there may be a difference between the way that something might have been accounted for and its corresponding tax treatment. So, for example, when it comes to repairs or improvements, case law tells us that for tax purposes, replacing part of an asset is a repair, whereas replacing substantially all of an asset is capital. So let's say that your client owns a building and they need or they want to replace the roof on the building. So a lot of expenditure, and the old roof might well be old slate, and they want to replace it with a modern tile roof. The roof is simply part of the building. It's not a separate asset in itself for tax purposes. And therefore, for tax purposes, that is revenue expenditure. It's a repair. But it may well be that the company argues that it has depreciated the roof over its useful life, So therefore, the old roof has been written down to virtually nothing. So for accounting purposes, it's replacing an identifiable component of an asset, and that allows it to capitalize. In fact, it requires it to capitalize the cost of the replacement. So in the accounts, it shows it as an addition to the property, but for tax purposes, it should actually be treated as revenue expenditure. That creates a problem because revenue expenditure, trading expenses, are only allowable when they are included within the profit in accordance with generally accepted accounting practice. So this roof replacement has been capitalized in the accounts, so it's not in the P&L. And it'll only come into the P&L as and when the new roof is depreciated each year. Well, when it's depreciated, that's when it will be tax deductible. It won't be deductible immediately if it hasn't been debited to the P&L in accordance with generally accepted accounting practice. Similarly, replacing single glazed windows with standard double glazed windows in an office, for example, the windows are not separate assets. They're simply part of the building. So replacing all the windows is very expensive, but for tax purposes, it is revenue expenditure. Again, the company may have argued that it's written down the building through depreciation, which incorporates writing down the windows, and therefore it's going to treat the replacement of the windows as capital for accounting purposes. So again, because it's revenue for tax purposes, the company will only get a deduction against its profits when that expenditure is recognized in the P&L in accordance with generally accepted accounting principles. So as and when it's depreciated. But when it comes to things like rewiring, that's different. If the company rewires the entire premises, electrical systems are a separate asset in tax law. They are features integral to a building, or they are a feature which is integral to a building. So if you replace the entire wiring system, then that is capital in nature, and it will qualify for capital allowances as integral features. So it can utilize the AIA, but if it doesn't utilize the AIA, then it would qualify for a 50% first year allowance as special rate expenditure. If you part replace wiring, if you rewire some of the premises, but not all of it, then the tax legislation says, look at the amount that has been expended on a rolling 12-month period. And if the expenditure that's been incurred on the rewiring over a rolling 12-month period is greater than 50% of what it would have cost to replace the entire wiring, then the expenditure that's been incurred is capital in nature. And the company, again, would claim capital allowances on that expenditure. But if the amount that's been incurred on a rolling 12-month basis is less than half of what it would cost to replace the entire wiring system, then the expenditure is revenue in nature. And if the company has written off the cost to P&L, it'll be tax deductible immediately. Again, if the company has capitalized the partial rewiring, then it won't get a deduction for corporation tax purposes until that wiring appears in the P&L. In other words, again, through a future depreciation charge. Another area which is based on extremely old case law, and those of you that are qualified accountants or qualified tax practitioners would have come across these cases, I'm sure, when you were studying, no matter when you studied, because these cases date back to the 1950s and 1960s. So the question is, if your client buys an asset, a second-hand asset, a used asset, and spends a lot of money on it before they bring it into use, is that capital or revenue for tax purposes? And case law tells us that it depends, first of all, on whether the purchase price was affected by the fact that we would need to spend this money. So did the vendor take account of the fact that we would have to spend a lot of money to then bring the asset into use for ourselves? And if so, then the expenditure is almost certainly capital in nature, because it's bringing the price up to what you would have paid for a ready usable asset. And also, was the company able to use the asset economically without that expenditure being incurred? Now, the two leading cases on this are the Law Shipping Company and Odeon Associated Theatres. In the Law Shipping case, the company purchased a used vessel, cargo vessel, and it would have been able to make one more journey with cargo to and from its port, and then it would need to be dry docked and go through a very major overhaul. Now, the price the company paid reflected the fact that it needed this overhaul very soon, and the one journey to and fro would not have been economical. In other words, the company could not have made an overall profit if they just bought the boat at, albeit a smaller price, to make that one journey to and fro. So although the company wrote off the cost of the overhaul in its P&L, so for accounting purposes treated it as revenue expenditure, which apparently the auditors agreed with at the time, HMRC argued, the Inland Revenue argued way back then, and the courts agreed that because the company would not have been able to economically use the boat without carrying out this substantial expenditure, this substantial overhaul, the expenditure it incurred was capital in nature. So it had to be disallowed as a trading expense, and instead capital allowance is claimed, which back in the day would not have been 100%. The case of Odeon Associated Theatres, the company selling the theatre was using it as a theatre right up to the date on which it was sold. But it was very old and tired. And if you ever read the history of Odeon, the theatre stroke cinema company, it's fascinating how they actually managed to dominate the world of cinema by offering an extremely high quality offering to the public. So they felt they couldn't open this theatre as Odeon in its current state. So they shut it down, spent a small fortune of the time in renovating it, and then opened it once they thought it was in an appropriate condition to meet their brand and their objectives. They wrote off that expenditure again against their profits for accounting purposes, which the auditors again agreed with. And in that case, the court said, well, you would have been able to use that theatre to earn a profit. So therefore, you would have been able to use it economically without the money you spent. And therefore, we consider that having written off against your P&L for accounting purposes, it is revenue in nature for tax purposes. So those are still the two leading cases on buying an asset and spending lots of money on it before you bring it into use. What I would say is that in both cases, the companies wrote off the expenditure against their profits. If your client if your client capitalizes that expenditure, then they will have no argument whatsoever that that expenditure should be treated as being revenue in nature. Once they've capitalized it, they're accepting its capital in nature. Now, when it comes to asset acquisition, we know that, for example, legal and professional fees in connection with the purchase of an asset are capital. They form part of the cost of the asset. But the question is, what happens about legal and professional fees where you are looking to purchase an asset, but the deal falls through? So let's say that, for example, your client is looking to acquire a new lease on some new premises. So they're looking to move and sign a lease on some different premises. It's all going very well. Negotiations with the landlord are proceeding in a very positive fashion. So your client engages the services of an architect and a surveyor to go and do some work on the building, go and do some research on the building, go and plan how the floor space might be used and any alterations that might be made. And they engage lawyers to start looking at the draft heads of agreement and the draft lease clauses. And then for whatever reason, the deal falls through and the lease is never signed. So the company never acquires the lease, and therefore the expenditure it's incurred on legal and professional fees must be expensed in the P&L. So the question is whether that's revenue or capital in nature. And the answer is that it's capital in nature, because the purpose of that expenditure was to enable the company to acquire an asset, something that will give it an enduring benefit. The fact that it never happened doesn't change the purpose. And therefore that expenditure must be permanently disallowed for corporation tax purposes, permanently disallowed. It can never qualify for deduction because to claim deduction for capital expenditure, you must be later disposing of an asset. And you can't dispose of an asset you never acquired in the first place. Now, one other area which often causes problems is sponsorship. Now, sponsorship can potentially qualify for deduction. There's no specific tax law around it, so it will qualify if the expenditure can be said to have been incurred wholly and exclusively for the purpose of the trade. And therefore, for example, if your client is a small owner-managed company and the company sponsors the football kit of the children of a director, and they, I don't know, spend 400 or 500 quid on paying for the jerseys that have the company's logo on them, then HMRC would not have any great problem with that whatsoever. It's a relatively small amount of money. There is potentially the chance the company could benefit from it because it's marketing, it's advertising. Although not many people are going to see it, it might just bring some business in. The problem comes when the sponsorship is irrational. In other words, it doesn't have a provable business rationale, or HMRC can demonstrate that at least part of the reason why the sponsorship's being paid is personal. Because once they establish that, then it's not wholly and exclusively for the purpose of the trade. Now, case law suggests that there has to be some kind of measurable benefit from the sponsorship. So you must be getting something concrete in return. But if there are personal motives apparent and the amount of sponsorship being paid seems to be irrational to the benefits that could be obtained, then HMRC will push for a disallowance. The most high-profile case in recent history was a gentleman who ran in the Plymouth area, ran a company which was a fish trade. It was a fish trade. They caught and sold fish, and he decided he wanted to sponsor Plymouth Albion. Is it Plymouth Albion? Plymouth Albion Rugby Club. They're in the second tier of rugby union, and he sponsored the company that runs the rugby to the tune of something like £1.3 million over a 3 or 4 year period. His company put that amount of money in. Now, he was a supporter of the rugby team, and in testimony, he said that he would love to see them in the Premier League, in the Rugby Union Premier League or Premiership. So he wanted to put money in to help them get better players so that they would achieve that objective. They never have, by the way, but that was the objective. And he said that by sponsoring the rugby team to that level, he essentially became somewhat of a celebrity in the area of Plymouth. And he said that that opened doors to conversations with things like bankers and to customers and to suppliers. They all wanted to talk to him because he was seen as being some kind of savior of the rugby team. So he claimed that during the relevant period, the company's profits had increased dramatically. And he attributed that to the sponsorship. And HMRC said that, that he had not set out the precise benefits the company had got from paying this money. Okay, there was advertising of the company around the rugby ground. And yes, their names appeared on the jerseys of the rugby players. But how many people actually saw that? Because only probably a few hundred or maybe 1,000 people went to watch the game. It's not broadcast on television, or certainly didn't used to be broadcast on television. There wasn't a wider audience. And so £1.3 million over 3 or 4 years seemed irrationally high. HMRC did offer the company a 5% deduction. They said that they would allow 5% for corporation tax purposes, but the company rejected that. The court said that HMRC should never have made that offer. That offer was essentially ultra vires. It was outside their powers to do so. And therefore, as a result, it said that there was a very strong personal reason why this company had sponsored the rugby club. The amounts they paid could not be matched by observable benefits of the sponsorship, and therefore they disallowed the whole lot, because they said that you couldn't make a reasonable apportionment of how much would be allowed, so the whole lot gets disallowed because it's not wholly and exclusively incurred. So please do watch out for companies that sponsor activities where the directors have a personal or vested interest in that activity. If the amount is irrational, then it needs to be disallowed. And if you don't, then HMRC would almost certainly open an inquiry, because the amount would stick out like a sore thumb, and they would disallow it instead. And case law suggests that your client doesn't have a bat in hell's chance of winning any argument on that matter. Okay, let's move on to have a look at corporation tax losses. The context of this is that at the moment, contemporaneously, if profits are below the lower profit limit, 50,000 divided by the number of associated companies, those profits are taxed at 19%. But if the profits are above the upper limit of 250,000 divided by the number of associated companies, those profits are entirely taxed at 25%. But profits that are sitting between those two limits are taxed at a marginal rate of 26.5%, slightly higher if the company has non-group dividend income, but certainly at least 26.5%. I would imagine that the vast majority, if not all of you, are familiar with this marginal rate, but it can be proven very easily that if a company has a profit of exactly 250,000, it will pay corporation tax at 25%, 62.5 grand. If it can claim loss relief to get those profits down from 250 to 50, so if it can reduce its profits by 200 grand down to 50 grand, then it only pays 19% tax on 50 grand, which is 9,500. So by reducing its profits from 250 to 50, it reduces its tax liability from 62.5 to 9.5 grand. That's a 53 grand reduction in tax for a 200 grand reduction in profit. And that's a marginal rate of 26.5%. So this offers the best tax saving when seeking loss relief. If we are looking to allocate losses to accounting periods, to other group companies, we're looking to target profits that are between the upper and the lower profit limit. Of course, if it's a group of companies, then the profit limit won't be 250 and 50, it'll be much less. It'll be those limits divided by the number of associated companies, which certainly includes all group companies. So we should aim, where possible, to use the losses to bring the profits initially down to the lower profit limit, because thereafter, we're only going to save tax at 19%. And maybe we can do better elsewhere. We can do better in a different period, or we can do better in another company, because it has profits being taxed at more than 19%. So that's the context. So we have to think about the options for relieving the losses and whether we are required to offset the maximum loss. So we can't just stop at the lower limit. We have to go on down to zero if necessary, or whether we can tailor the loss claims so that we can stop at the lower limit and then use the rest of the loss somewhere else instead. So when it comes to brought forward losses, old losses we're bringing forward to use in current periods, If they are losses that have arisen before the 1st of April 2017, then those losses can only be, if they're trade losses, can only be carried forward against future profits of the same trade. They have a very restricted set-off in future. Any old brought forward non-trading loan relationship deficits can be carried forward against any profits and gains in the future, except for any trading profits. So old non-trading loan relationship deficits can be used in the future against anything other than trading profit. Any old rental losses still being carried forward, they've always been able to be offset against future total profits of the company. But they can't be group relieved. They can only be used against that company only. Capital losses, well, the law has always been the same. That never changed. Capital losses can only ever be carried forward and offset against chargeable gains of the company in a future period. But if you're dealing with post 1st of April 17 losses, so losses in the recent past, then they can all be carried forward, apart from capital losses, they can all be carried forward against total profits and gains of the company. And then any excess that the company can't use in a future period against its own profits can then be group relieved to other 75% group companies against their profits for that period. So you can't surrender losses to another group company, which would then carry them forward. They can only accept what they can use in that particular period. But when you're carrying forward losses and using them in a later year, the company that made the loss has to try to use them to the maximum extent before you can consider group relieving them to other companies. As I said, capital losses still carried forward against capital gains. And then we have to consider the so-called deductions allowance, which is that you can only fully relieve £5 million of current year total profits with losses brought forward from earlier periods. Any profits in excess of 5 million, and that's a group-wide allowance. So we have to allocate this 5 million across companies in the group. Any profit you're seeking to reduce by brought forward losses in excess of £5 million can only be reduced by 50%. Okay, by 50%. That's brought forward losses. The one thing about brought forward losses since April 17 is that you are allowed to tailor them and use as much or as little as you like. You don't have to use the maximum. So if I've got a brought forward trade loss of 100 grand and I've got current year profits of 60 grand, I don't have to reduce my current year profits by 60 grand. If I want to, I can, but I could just reduce them by 10 grand to take them down to the lower profit limit. So I save tax at 26.5% on those losses. And I could, if I wanted to, carry forward the rest to a later year. Now, it does mean that I'm delaying relief because I could get a refund or I could cancel my tax liability completely for this year, but I would only be saving tax at 19% on 50 grand of the losses I use. So for some clients, they may be happy just to write the profits down to zero, but other clients may think that if they're going to be very profitable in the following period, excuse me, and by the time you're dealing with these losses in the current period, you're already probably quite a long way into the following period when you're preparing the return. So therefore, you get a feeling for how well the company is doing in the following year and whether the company would benefit more by not taking full loss relief in the first later year, but by carrying losses forward to the year after that. Because then maybe that can save tax at 25% or 26.5% again. So with brought forward losses, there is some planning. There's a lot of planning we can do because we're allowed to tailor the amount of loss claim up to the maximum to whatever we like. And I don't think many practitioners think about that enough. I think your software would just offset it in full unless you intervened to tell it differently. When it comes to current year trade losses, that's different. Because you can elect to use current year trading losses to reduce current year total profits. But you have to reduce those profits to zero if you have enough loss. You can't tailor a current year claim. Then, if you have reduced your current year profits to zero, you can then elect to carry back the remaining loss against the total profits of the previous 12 months. But again, you have to use as much loss as you possibly can. You're not allowed to tailor these losses. Any remaining loss, or if you don't want to use current year relief and carry back relief, any remaining loss gets carried forward. And when you carry it forward, then you can start tailoring how much you want to use in a particular future year. When it comes to current year non-trading loan relationship deficits, so if your client has borrowed money for a non-trading purpose, like to make an investment or a property investment, then any interest expense will be a non-trading loan relationship debit. If your client is earning sundry interest income, but they're not a money lending company, then that's a non-trading loan relationship credit. And they'll offset those two things together, the debits and the credits together. If they get a net debit, then that is called a non-trading loan relationship deficit or loss, if you prefer. And that can be relieved in one of four ways. And again, you can specify the amount of the loss you want to use in any particular way. So you can use some or all of that deficit against your total profits of the same period. You can instead, or as well as number one, carry back and use those losses against non-trading credits of the previous 12 months. And you can also, by the way, use that against any derivative credits, so any derivative profits in the P&L of the previous 12 months. And or you can surrender all or some of that non-trading loan relationship deficit to other 75% group companies. They will use it against their total profits for the same period. And or you can carry forward some or all of it. And if you carry forward, you offset against total future profits as and when you wish to do so. So these losses, in any case, you can specify the amount you wish to use and the amount you don't wish to use. Again, it gives you flexibility so that you can, if you wish to do so, tailor your loss claims so as to ensure that your losses always get relief at the highest possible rates, 26.5% or 25%. As I mentioned briefly before, you can now group relieve brought forward. Sorry, question coming. Thank you very much. Can non-trading loan relationship losses brought forward be used against trading profits? Claire, if they're post 1st of April losses, then yes. If they're pre 1st of April 17 losses, then no. So group relief have brought forward new losses. The company has to offset its brought forward new losses against its own profits. By new, we mean since the 1st of April 17, against its own profits before it's allowed to consider group relief. So if it wishes to tailor its losses against its own profits in a future period, so it doesn't offset the maximum that it could, then it's not allowed to group relieve the excess. It's got to use the maximum itself first if it wishes to group relieve any of those losses to other group companies. The claimant is not allowed to claim more than it can actually offset in its current period. And the law says that you can't surrender losses to a company that at the end of its period has no income producing assets. So it may well be that a fellow group company traded for 9 months of the year, and then its trade was sold to a third party, and all of the cash was then distributed to the parent company. So by the end of that company's calendar period, whilst it had profits for the first 9 months, that's now been, the assets have been sold, the profit distributed essentially. And so as at the end of the period, that subsidiary now has no assets. It's got a profit for the year, but it has no assets at the end. So you cannot group relieve losses to that company. Sorry, you can't group relieve brought forward losses to that company. Ever since 2019, the legislation has now permitted UK trade losses brought forward to be surrendered to a non-resident company that has UK profits within the scope of corporation tax. So you might act, for example, for a property investment group, which has trading activities as well. It may well be that there's a Channel Islands company that has rental property in the UK. So it's not a UK resident company, but it has a property business in the UK. The profits of that property business are subject to UK corporation tax. So if there is a UK group company that has trade losses brought forward, it can surrender those losses against the non-resident Channel Islands company's property profits. That's perfectly acceptable. Now, the mechanics I can show you by means of a very quick example. Let's say that your client has 2 losses brought forward. One relating to the year end March 17, so it's still being carried forward, 50 grand of losses left over. They're old losses. And then it has a loss arising in the year end March 21 of 110 grand that it's still carrying forward. It hasn't relieved as yet. So let's assume that it has a 75% group company B. And in the most recent year end, March 23, A has profits of 30 grand from trading. It has other profits of 45 grand. So it has a total of 75 grand of profits. And B has trade profits 23 grand, other income of 13. So total tax and profits of 36 grand. So what I want to do is just to consider with these numbers, the possibilities for using the brought forward losses. Now, the first thing to say is that it is possible here to make the maximum loss claims. If we make the maximum loss claims, then the first loss that we should really deal with, sorry, let me just come back to that. I apologize, I'm trying to get some ink on the screen. The first loss that we should deal with is this 50 grand. It's an old loss, and it can therefore only be used against the trading profits of A Limited from the same trade in future. So if you want to make a maximum loss claim for that 50 grand, the only place it can go is here against this 30 grand. So it can wipe out the 30 grand, and that's going to leave 20 grand to carry forward. You'll have to excuse my writing on a computer. I'm using the mouse. The mouse is in my right hand and I'm left-handed. So this is a challenge, I can tell you. So it leaves 20k to carry forward. That's all you can do with those losses. And that's the maximum claim that you can make. You don't have to make that claim. If A Limited doesn't want to, it doesn't have to offset the entire 30k against these trading profits. That's the only thing it can do. But it could decide to offset a smaller amount, which I'll come back to later on. Now, the 110 grand is a bit more flexible. The 110 grand we can probably do quite a bit more with, because that's a new loss in loss terms. Excuse me, just a minute. That's a new loss in loss terms. So what we can do, if we wish to do so, is we can take this 110 grand. We can, first of all, wipe out these profits of 45, because you can offset a current year loss against total profits. We can group relieve against the entire profits of B Limited. So we can wipe out the 36. So that's got rid of 45k. It's got rid of 36k. And the rest of the loss we can carry forward. Okay. If we want to make a maximum claim, we just carry forward the rest. So that's 81k we've used. So that leaves 29k that we haven't used, and that will be carried forward. That's making the maximum loss claims. That would wipe out the profits for the current year, so that neither A nor B would have any tax liability for the current year. But bearing in mind that the upper profit limit, if there's only 2 companies in the group, the upper profit limit is 125 grand. It's 250 divided by the 2 associated companies. And the lower profit limit in both cases is, for each company, sorry, is 25 grand. What we might have preferred to do is to reduce both companies' profits down to 25 rather than fully reducing them. So perhaps we prefer just to reduce the profit of A by 50 and the profit of B, just reduce it by 11, because it means that on that 61k of loss, we've actually saved tax of 26.5% marginal rate. And if the company is confident, if the group is confident that in future years, it will be making substantial profits, then we can save tax at 25 or 26.5% in the future. Now, I have to say that in practice, most clients would prefer the first answer, which is to reduce the profit down to 0. But they could achieve 6 or even 7.5% more tax savings by carrying forward more loss into future years, which may or may not be worthwhile for them. But the emphasis I wanted to give you was that you don't have to make maximum loss claims when it comes to brought forward losses. Current year losses, different thing. Brought forward losses, you can tailor them to your heart's desire. Any questions? Okay, so the answer here just focuses on using maximum loss relief, but I wanted to just try and make it a bit more subtle and a bit more nuanced so you understand the issues that should be involved in loss planning. Just some anti-avoidance legislation to be aware of, that if a company joins a new group, then the general rule is that none of its pre-acquisition losses, so none of the losses that it generated while it wasn't a member of the group, even if they are post-April 17 losses, none of them can be surrendered to members of the new group. So you can't surrender losses brought forward to group companies where the losses arose before the company joined the group. There's a very small exception to that rule, which is that if the company before it became a 75% group member was a consortium company and the new group was a consortium member of that consortium, then even before the company became a 75% group member, some of its losses could still have been surrendered to the group. Well, that can continue after it becomes a 75% group member, but only based on the percentage held while it was a consortium member, not the amount that's now held. So consortium relief can essentially continue, but group relief is still banned. There doesn't seem to be any restriction the other way around, however. So if a pre-existing group has brought forward post-April 17 losses and it buys a profit-making new group company, so a new company joins the group which is making profits, there's absolutely no restriction on using the group's pre-acquisition losses brought forward against the newly acquired company's post-acquisition profits. It's only a one-way anti-avoidance rule. And the whole emphasis of anti-avoidance when it comes to losses is around buying companies for their losses. So the government is very keen to avoid a situation where a company is purchased simply to get access to its losses. It's called loss buying. Yeah, the government does not like loss buying. So if you buy a profit-making subsidiary, there's no problem. Yeah, that's not loss buying, that's profit buying instead. Okay, let's have a look at some key issues around loan relationships. We'll make a start, probably have a coffee break shortly, and then finish off and have a look at hybrid mismatch afterwards to finish the session. So, the computational aspects, very important to understand, and this applies to a hell of a lot of corporate tax legislation these days. The amounts which are reckoned for tax purposes when it comes to loan relationships are amounts that are recognised as debits or credits in the P&L, so income or expenses in the P&L, computed in accordance with generally accepted accounting practice. So if a client hasn't complied with generally accepted accounting practice, and the difference between what they should have done and what they have done is material, I mean, they might not be audited, so it's not a question of an audit qualification in their audit report, then if they insist that the accounts they prepared are the ones that will be filed, then we would have to make adjustments anyway for tax purposes to make sure that the numbers we were using for tax purposes did comply materially with generally accepted accounting principles. GAAP for this purpose defined as either being UK GAAP, that can be either FRS 102 or 105, whichever one the company is using, or it can also be UK adopted IAS. But no other GAAP is acceptable for UK tax purposes. So if you act for a UK branch of a foreign group, and the UK branch has to file corporation tax returns in the UK, because the branch is a permanent establishment here, and it prepares its accounts using, for example, Dutch GAAP or German GAAP or French GAAP or US GAAP, those figures are not prima facie acceptable for tax purposes, and we would have to adjust them for corporation tax. We'd have to work out what the numbers would be if they used UK GAAP. The debits and credits we typically see in connection with loan relationships are things like interest income and expense, any fair value adjustments to loan relationships, things like bond investments, for example, which have gone through the P&L, and the impairment of loan receivables and the impairment of other types of financial assets. Now, the law also says that if debits and credits are recognised in OCI, other comprehensive income, then they will be ignored in the period they're recognised in OCI if they are expected to be recycled to the P&L at a later point. But if not, if we're not expecting to be recycled, then the law says that they'll be taxed when the loan relationship is de-recognised in the accounts. Now, I do a lot of work on accounting, both the UK GAAP accounting and IFRS accounting, as well as tax. And I can't think of a single example where this would ever happen. So if you ever come across this, I would think again. I would think whether what they're doing is actually correct from an accounting perspective. It can happen with foreign exchange gains and losses. I accept that. But pure loan relationship amounts, I don't think so. So let me show an example with foreign currency amounts, because the law quite clearly states, by the way, that foreign currency gains and losses relating to loan relationships are themselves within the loan relationship legislation. They're taxed under the loan relationship rules. So this is the only kind of example I think we might come across. Let's say that we've got a client that has a functional currency of sterling and it borrows 10 million US dollars in the middle of 2022, or in the middle of 2022, to finance the purchase of some inventory, which it knows is going to cost it 20 million US dollars. So it's using the borrowings as a currency hedge against the fact they've got to pay dollars for the inventory. That inventory, the stock, will be delivered in early 2023, and it will be sold shortly after deliveries. After all, it's inventory, yes? The loan gets designated by the company as a currency cash flow hedge against the risk of the inventory cost in sterling terms fluctuating because of movements in the exchange rate. And therefore, the foreign exchange, let's say it's a gain, on retranslating the loan, the 10 million loan, let's say that's just over 500 grand. Normally, when you retranslate a foreign currency monetary amount, like a loan balance, UK GAAP says, RFS says, put it through the P&L. But if the loan is designated as a hedge against a future transaction, then we don't do that. We put the gain or the loss initially into OCI. When the stock or the inventory is sold in 2023, the OCI gain, including any further exchange rate movement since then, gets transferred across from OCI into the P&L. So the question is, how do we deal with all that loan FX differences for corporation tax purposes? You need to understand that in the main, the loan relationships are designed so that as far as possible, the tax treatment follows the correct accounting treatment under generally accepted accounting principles or practice. So, because the gain was booked into OCI, it's a foreign currency gain, and because it relates to a loan relationship, it falls under the loan relationship rules. Because it was always expected that we'd recycle it into the P&L when the inventory was sold, then we only tax it when it goes through the P&L. That's just the general rule, really, that the debits and credits we take account of are generally those booked in the P&L in accordance with GAAP. So anything booked in OCI that's going to end up in the P&L, we wait until it hits the P&L. So we don't have to make any adjustments whatsoever in the corporation tax computation, because accounting principles mean that the gain will hit the P&L in 2023, and that's when the company will pay tax on that foreign currency gain. The only thing the company would need to do is, if it has a December year end, then it would have to book a deferred tax liability against the gain it's recognised in OCI as at the 31st December 22. And because it's expecting that gain to reverse out in the following 12-month accounting period, year end December 23, it needs to book deferred tax at 23.5% if it believes that the company will pay tax at 25% from the 1st of April 23, such that in the following 12-month period, 3 months of its profit will be taxed at 19 and 9 months will be taxed at 25. Then it should be booking deferred tax at the end of 2022 at 23.5%. That deferred tax liability, to recognise the fact that the company has made a gain of 500 grand, but it hasn't been taxed on it yet, but will be, that's booked in OCI because that's where the gain is booked. So we'll have a debit in OCI for the deferred tax and a credit to a deferred tax liability account. And that deferred tax will be reversed out when the real tax is charged in 2023. Okay, let's stop for our second break at this point. We'll come back in 10 minutes time. I make that 11:16, and we'll pick things up final 45 minutes, focusing on a few more loan relationship issues, and then finishing by having a briefish look at some of the main issues around hybrid mismatch rules. So back in 10, please. Okay, let's start again our final session for today. Let's move on to have a few other loan relationship issues, and then we'll take a little look at the hybrid mismatch rules. So when it comes to capitalized interest, just from an accounting perspective to begin with, both the UK GAAP and, both IFRS and therefore FRS 101, if your clients use that, requires the capitalization of interest if you are constructing what's called a relevant asset, one which necessarily takes a long time to manufacture or create. UK GAAP permits capitalization in these circumstances, but it doesn't actually require it. So the tax law says that if a company has capitalized interest into the cost of what it calls a non-GAAP taxable item, that is an item which is not taxed on the same basis that it's accounted for, is treated as a loan relationship debit when it's incurred. So the fact that you've added the interest in the balance sheet to the cost of the item is ignored for tax purposes. And for tax purposes, it's as if you hadn't capitalized the interest and you'd passed it through your P&L. That covers things like property, machinery, investments, maybe as well, that sort of thing. However, the law says that when interest has been capitalized, excuse me, on an asset which is GAAP taxable, in other words, the tax treatment follows the accounting treatment, then the interest is only treated as a loan relationship debit, so it's only deductible when it's debited in the P&L. So if it's been capitalized at year end, it's not in the P&L, so it doesn't get tax relief until it hits the P&L sometime later. And that's going to apply to things like intangible assets, where by default, the tax treatment follows the accounting treatment, and also inventory or stock. But if, for example, your client is claiming the special 4% allowance for intangible assets, or in the case of software, they treat it as being plant and machinery expenditure, as they're allowed to, making an election under section 815 of CTA 2009. Well, if they claim the 4% straight line allowance, or they claim it for capital allowances, then now the tax treatment isn't the same as the accounting treatment. And so any interest they capitalized into the cost of that intangible asset is treated as a loan relationship debit when it was incurred. Because now that intangible asset is no longer GAAP taxable. And so we defer to the rules that we just talked about up here. If you're using draft accounts to produce some kind of tax provision, then it won't be obvious whether interest has been capitalized or not. So you'll have to ask the question. If you have a full set of accounts and you're now filing the tax return, then you should have all the information you need to make that decision. Now, just a couple of quick examples. Let's say that a client has a year-end December 22. During that period, they finish the construction of a building, which they're going to use in their business, where the building costs 130 million, including 5 million of interest that's been capitalized, let's say, this year. And at the same time, they've concluded a computer software project that had a cost of 12 million, and they have capitalized £1 million of interest this year. They're going to depreciate the building element of the land and buildings over 50 years. They're going to amortize the software over a period of 8 years, starting next year. So what adjustments, if any, do we need to make to the 2022 profit for corporation tax purposes? So if they've constructed a building, then the most they'll get out of that for tax purposes is a 3% SBA. So it's not being taxed on the same basis that it's being accounted for. And therefore, the interest that's been capitalized hasn't gone through the P&L this year, but we treat it as tax deductible against the 2022 profit. So we deduct 5 million from the 2022 profit. The software, well, it's all going to depend upon the tax treatment of the software. If the company claims just the normal intangible asset relief for the software, then the cost will be amortized over 8 years, and the tax relief will be the accounting amortization, which means it's a GAAP taxable asset. And that means that the treatment of the interest follows GAAP for tax purposes. So forming part of the cost of the asset, the interest will be amortized over 8 years as well. And that's when it will qualify for tax relief. If the company decides to claim the 4% allowance instead of the accounting amortization, I don't know why they do that, but if they did, then it would no longer be GAAP taxable, and the interest of 1 million would be deducted against the 2022 profit for tax purposes. And if they elected to treat the software as plant and machinery for capital allowance purposes, which they're permitted to do, then again, it won't be a GAAP taxable asset. And so the interest would be fully deducted against the profit of 2022, even though it's included in the balance sheet at the year end. So the next slide just runs through that analysis in a bit more detail. If the client has a development property, so they have included, for example, the construction costs in work in progress at the end of the year, and they've capitalized interest during the year into that work in progress of 10.5 million, and then they are going to sell that development, but let's assume they do sell it in the following year, then the inventory, the development property, is a GAAP taxable asset. It's going to be deductible for tax purposes when it's recognized as an expense in the P&L. So the tax treatment follows the accounting treatment. That means that the interest, having been added to the cost of work in progress at the year end, December 22, is not tax deductible until it goes through the P&L account when that development property is sold. So this 10.5 million would be tax deductible in 2023, not 2022. And in fact, as soon as you come across a GAAP taxable asset, you don't need to do anything for tax purposes, because it'll appear in the accounts when it's supposed to appear in the accounts, and that's when it's relevant for tax purposes. So just follow the accounts and you get your correct tax treatment. We then have the concept within CTA 2009 of deemed loan relationships. They're referred to actually as relevant non-lending relationships because they don't involve the lending of money. So a trade creditor, a trade receivable, is a non-lending relationship because it's money which is owed, it's a money debt, but it didn't arise from the lending of money. That is relevant for loan relationship purposes, even though there's no loan here. It's relevant when it comes to interest being charged. The interest falls under the loan relationship rules. It's relevant when exchange gains and losses arise. They're taxed under the loan relationship rules. And it's important when you impair that item or you reverse the impairment. So why is this important? It's especially important where there is a non-lending balance that relates to a connected company debt. We're going to talk about connected companies in a moment, but broadly speaking, when a connected company lender writes off a debt to a connected company borrower, the debit for the write-off is not generally tax deductible. So what this is saying is that doesn't just extend to lending relationships, it also applies to any other money debt, which might be some sort of trading balance as opposed to a loan balance. Again, the write-off of a connected company debt, be it a trade debt, be it a loan debt, will not generally be deductible for the company that writes off the debt. The rest of this, don't worry about, please. Yeah, don't worry about this. So connected companies. Two companies are connected for the purpose of the loan relationship rules if one controls the other, or both are under the control of the same person. The same person. Unlike associated companies, which can be the same person or persons, this one's just about person. Control is power to secure the company's affairs. Generally, that can be through shareholding, it can be through voting power, it can be through the Articles of Association, but that's it. It's all about securing that the company's affairs are conducted in accordance with someone's wishes. So it's the literal definition of controlling somebody or something. So it doesn't talk about the fact that if you're entitled to more than half of the assets that are winding up, half the income distribution, none of that comes in. Just do you have control? And why is that important? Because, first of all, slightly less important, for tax purposes, a connected company loan relationship must be measured on an amortized cost basis, irrespective of what they've actually done in the accounts. Now, the only alternative to an amortized cost basis in accounting would be a fair value basis. So if a loan between connected companies has been fair valued by either party in the accounts, then you cannot rely on those accounts to get the tax computation wrong. Correct, beg your pardon. You have to make sure that you adjust the accounting numbers as if the loan was accounted for on an amortized cost basis instead. So the fair value adjustment might give rise to some sort of P&L effect. That is disregarded if it's a connected loan relationship. But the most important implication is that as a general rule, you cannot claim a deduction for writing off a connected company loan receivable or deemed loan receivable, so a connected company receivable balance. Unless the lender is in an insolvency procedure, not the borrower, the lender, or there's been a debt for equity swap. So the lender wasn't connected before, but the loan has been partly swapped for shares, and now the lender is connected with the borrower. So if there's a write-off, a partial write-off of a loan, and part of the loan is swapped for shares, and that gives the lender control over the company, then the write-down of the loan at that stage is deductible. Now they're connected. If there would be a further write-down later, then that would not be deductible. The borrower is not generally taxed on any credit for a connected company debt which has been released by the lender. So the borrower is going to debit loan payable, credit their P&L on being released from the debt. That credit is generally not taxable on them. Even if, by the way, the debit would be deductible for the lender. So if the lender is in an insolvency procedure, the lender does get a debit allowed for the write-off, the borrower is still not taxed on the write-back. And you can't circumvent the rules by selling what is already connected company impaired debt to a third party for a reduced amount. So you might think, well, okay, we can't write down the debt because that would be disallowed. So why don't we sell this intercompany debt to a third party for £1, record a loss on disposal, and allow that instead? Well, the law caters for that and says that if you sell connected company debt for less than the carrying value, then the loss you report in your P&L is not deductible. Of course, if the write-down is not deductible for any impairment, if the lender is able to reverse that impairment, partially or wholly later, then the write-back is not taxable. Okay, the write-back is not taxable because the write-off wasn't deductible. None of this has any impact on exchange gains and losses. So if the amount that's being lent is in a foreign currency, okay, if the amount being lent is in a foreign currency, then the the lender may have to retranslate the loan at the end of the period, and that could give rise to a currency loss. That currency loss is not the write-off of a debt. It's just the restatement at the closing exchange rate, and therefore it's perfectly allowable. So the sort of situation you might find yourself in, you've got parent subsidiary loan. So the parents lent 10 million at a market rate, which is currently 5%. And in the year ended December 21, let's say, could be 22, doesn't matter, but the subsidiary's financial position has deteriorated, and it has failed to pay the interest owed for that year by the end of 2021. And now the parent has serious doubts that the subsidiary would be able to repay the loan, or if it did repay the loan, that it would then become insolvent. It wouldn't have enough money to continue. So the directors have to consider their legal position in the lending company, because they have a duty to act in the best interest of their shareholders primarily, whilst having regard to other stakeholders. That's under company law, section 172 of the Companies Act. And they've decided that on balance, it would be better for their shareholders and would have no real adverse effect on any other stakeholders if they were to waive the loan. And you have to formally waive the loan. So if you don't formally waive the loan in law, then the borrower still technically owes the money. So they draft a deed of waiver and get it signed and witnessed right at the end of 2021. So the parent writes off the capital and the accrued interest income for this year, and the borrower writes off the loan payable and the accrued interest payable for the year. The tax implications of that are that the parent's interest receivable, the accrued interest income of 500 grand, 5%, 10 million, that's still taxable. Because the write-off of that balance is the write-off of a connected company debt, and the write-off is not deductible. So it's not just writing off the principal, which is disallowed, it's writing off the interest as well. But the interest should have been accrued over the year in any case, and therefore will remain taxable on the parent. The subsidiary should have accrued interest payable, again of £500,000, and that is still deductible, subject to any other restrictions in the law. And then releasing the liabilities, because it's connected company debt, that's not taxable. So releasing the debt, including the accrued interest, that credit is not taxable at all. The end position, therefore, is that when this is all completed, the parent ends up having to pay tax on 500 grand of interest income, and the subsidiary gets a deduction for 500 grand of interest expense. Now, that's loans between connected companies. In all other situations where the lender waives or writes off or impairs a debt, that will be an allowable loan relationship debit for a company. An unincorporated business writing off a loan. Mark, thank you for the question. If it's interest-free, then the write-off is tax neutral. Yeah, if it's interest-free, it may well be that under generally accepted accounting principles, we still have to account for accounting interest expense. If it's a term loan, which is interest-free, then both the UK GAAP and IFRS say that you have to initially record the loan at the present value of the amount to be paid at the end, and then you have to recognise some accounting interest. And slightly bizarrely, if you recognise that accounting interest in accordance with GAAP, then that's still taxable on the lender, and it's deductible for the borrower. Because generally speaking, the tax rules follow the accounting treatment. So, Mark, the only time that it would be genuinely interest-free and we wouldn't actually book any interest in the accounts is if it wasn't a term loan, it was a demand loan. In other words, it could be paid back, it could be asked to be repaid at any time. Then both parties have to state it at the amount it needs to be repaid at. But the flip side is they both have to report it as current asset and current liability, because it's a demand liability. When it comes to non-connected companies, the borrower is generally taxable on the release. So the lender gets relief for the write-off, the borrower gets taxed on the release, unless the release falls within one of the exceptions in section 322 of CTA 2009. There are 5 possible exceptions. The release is part of some sort of statutory insolvency arrangement of the lender. B talks about release of relevant rights. Don't worry about that. We're not going to cover that today. Thirdly, the borrower is in some kind of insolvency process like liquidation, administration, receivership, or there's some sort of adjustment because of some power under the Banking Act, or there is a material risk that without the lender writing off the debt, the borrower would not be able to pay their debts in the next 12 months. And therefore, if, for example, the lender doesn't write off the debt, that the borrower would have negative net assets, they have net liabilities, then you would trigger E here, section 3225B. Or if in any other case, it's judged that there would be a material risk that the company would become insolvent at some point in the next 12 months, then again, the borrower doesn't get taxed on the write back. Because if there's a risk they're going to become insolvent, and then HMRC charges tax on what is just a book entry, debit, liability, credit, P&L, then they're going to be charging cash tax on what is a book entry, and that's just going to make the borrower situation even worse. So that's why that's why C and E are here, so that if there is a write back of the loan by the borrower, because they have some sort of insolvency issue, either now or imminently, that the write back doesn't create a tax bill that then forces that insolvency anyway. Okay, other anti-avoidance rules, loans to participators in close companies. Quite a few years ago now, about 7-8 years ago now, the Corporation Tax Act was amended to prevent an allowable loan relationship debit arising for the company when it writes off a loan to a participator in a close company. So in the old days, prior to this, it would be reasonably common for a director shareholder of a close company to borrow money from the company, and then the company would just write off the debt periodically. And then before this change, the company would claim an allowable expense for the loan write-off for corporation tax purposes. And the borrower would be taxed on the write-off as a dividend, as a distribution. And actually, we could get a reasonably tax-efficient conclusion to this, because it's being taxed on the borrower as a dividend, and dividends aren't usually tax deductible, but prior to this change, the write-off you could claim was allowable because it was being subject to NIC as earnings. Oh, thank you, John. So it's being taxed as earnings instead, as long. So somebody suggests this change was made as early as 2010. I usually do underestimate how long ago things did happen, so that's quite plausible. Thank you. So nowadays, there's no question that if a close company is owed money by a participator and it chooses to write off that loan, then the borrower is taxed as if they've received a distribution equal to the amount waived. The company does not get corporation tax relief on the write-off. And if the borrower is also an employee or director of the company, then the borrower and the company are both subject to Class 1 national insurance on the amount written off. Because the income tax law says that the write-off could be both earnings or a distribution, and then has a tiebreaker that says, okay, then we tax it as a distribution. But the national insurance regulations would just say that this is earnings because the person works for the company and therefore should be subject to NIC. So writing off loans to participators in a close company who are shareholders, who are directors or employees, is very expensive now from a tax perspective. Other anti-avoidance laws, This one I get asked about an awful lot. There is some anti-avoidance legislation that sometimes bites when interest on a loan hasn't been paid within 12 months of the end of the company's accounting period. And the reason why this law is here is to stop a borrower claiming a deduction for interest which they've recognised as an expense in accordance with generally accepted accounting practice, but which is not taxed on the lender because, for example, they don't get taxed on an equivalent amount of accrued interest income because they're not within the scope of UK corporation tax, so not within the scope of the loan relationship rules. So where the lender is an individual, for example, or the pension fund of the company, then you get a mismatch between the borrower getting generally relief for an accrued amount they haven't paid and the lender not being taxed at all. So relief is denied for the company on interest debits in the P&L in certain limited cases where the interest hasn't been paid within 12 months of the end of the period in which it's accrued, and it hasn't been brought into account by the lender under the loan relationship rules. But they are very specific circumstances. First of all, where the borrowing company is a close company. If it's non-resident, then it would be close if it was resident. It's controlled by 5 or fewer participators. And the lender is a participator. It's a shareholder in the borrower. It's an associate of a participator, or it's a company which is controlled by a shareholder in the borrower. The second situation where the rules bite is where the lender is a company which is resident for tax purposes in a non-qualifying territory, broadly a tax haven. And the third situation is where the lender is a pension scheme of the borrower. In other words, one or more of the employees of the borrower or a fellow group company of the borrower is a member of the pension scheme that's lent the money. In any of those 3 cases, but only those 3 cases, interest which wasn't paid by the company for more than 12 months after the end of the year will only be deductible on a paid basis. But of course, the problem is that we may well be filing the tax return before 12 months after the end of that period. So we have to make a judgment call as to whether we think the interest will be paid if it hasn't been paid so far. And if we file a return on the basis it's going to be paid within 12 months, and it ends up that it wasn't paid, then we have to amend that corporation tax return within the following 12 months to disallow that interest in that return. Okay, those are some of the anti-avoidance provisions within the loan relationship rules. I'd like to spend the last 15 minutes we have together talking around something called the hybrid mismatch legislation or anti-hybrid legislation, but only talking around the common areas which you might see in practice, because the legislation has many, many different chapters covering different situations. And we could spend a good 6 hours discussing this topic and still not cover everything. So I'm going to focus on 3 particular areas: hybrid payers, deduction non-inclusion mismatches, hybrid payers when it comes to double deduction mismatches, and then group relief, if you like, of something called dual inclusion income, because they're the ones we're more likely to come across. So what's a hybrid entity? A hybrid entity is one which is regarded as opaque in one tax jurisdiction, but transparent in another jurisdiction. Or in the case of a hybrid payee, an LLP is always a hybrid entity, but we're not going to cover that in detail today. The most common scenario that I come across is a UK subsidiary of an American parent company, because America has strange tax legislation called the check the box regime, where a UK subsidiary of an American parent can check the box for its American filing purposes. And if it checks the box for American filing, it means that all of the revenue and the expenses of the UK subsidiary are treated as if they were the revenue and the expenses of the American parent for its tax filing in America. Which, amongst other things, means that if the UK subsidiary's expenses exceed its revenues, its loss-making, it effectively means that the American parent company can use that loss to reduce its own profits. But if the UK company is profitable, then it's going to pay UK corporation tax. And because the check the box election means that the revenue and the expenses of the subsidiary are treated as trading profits of the parent, then the corporation tax payable in the UK on the trading profits must be creditable for double tax relief, because it's being set against the US tax on the same trading profit, rather than it being a separate entity and then paying a dividend to the US, because then you've got corporation tax paid on a trading profit, but the US company's income is then dividends for tax purposes, and that could have a different impact for double tax relief. So I mainly come across this, where you've got a UK subsidiary of an American parent, and there is a check the box election in place. Sometimes Americans refer to it as the UK subsidiary has been checked open. If they say it's been checked open, they mean it's been made transparent for American tax purposes. So the company's revenue and expenses are treated as the American parents for tax purposes. Now, there are 5 conditions that need to be met for there to be a potential counteraction if you have a hybrid payer. Now, we're talking here about the UK subsidiary making a payment to or incurring an expense with the American parent. So first of all, is there a payment under an arrangement? Very vague. Is the payer a hybrid entity? Is the payer or one of the recipients within the charge of corporation tax? In our scenario, the payer will be. Condition D, I always refer to as the sort of Scooby-Doo clause, because at the end of every Scooby-Doo episode, the villain always says, if it wasn't for you darn kids, I'd have got away with it, or something like that anyway. Pesky kids, maybe. Pesky kids? Might be pesky kids. Anyway, this one says, in the absence of the hybrid mismatch legislation or equivalent legislation overseas, you would have got away with it. You would have got a deduction in the UK without something being taxed in the other jurisdiction. Deduction, non-inclusion, mismatch. And finally, the counterparties are in the same control group. So either they're consolidated in the same set of accounts, or at least one party owns 50% plus of the other. Or if they're not in the same control group, the whole deal was structured to give rise to a tax benefit, and that tax benefit is being shared amongst the parties. Now, don't worry about the change. Let's have a look at an example or two. Let's say that we have a parent in America. It's got a UK subsidiary. The UK sub is your client, and the parent has provided services to the UK sub, and the UK sub has a check the box election in place. So it's treated as being transparent for American tax purposes, but of course is a body corporate, fully liable to corporation tax in the UK. The expense for the service is ordinarily deductible for the UK company in working out its UK corporation tax. But because the UK subsidiary has a check the box election in place, then essentially its revenue and its expenses are consolidated with those of the parent company for American tax purposes. And you'll be aware, I hope, that if you consolidate, any intra-group transactions just get eliminated down to zero, because it will be an expense in the UK sub and it will be corresponding income in the parent. And when you add them together, that comes to zero. So therefore, the charge made by the parent in America to the UK sub never gets taxed in America with a check the box election in place, which means that you have a deduction in the UK for that service expense, but no equivalent income being taxed in America. So does it fall foul of the hybrid mismatch rules? Well, it certainly meets the conditions that we saw before. There's a payment in connection with the arrangement. The UK sub is hybrid because there's a check the box solution in place. It's liable to corporation tax. In the absence of any hybrid legislation, they would get away with it. There'll be a deductible expense in the UK and nothing taxed in America. And they are in the same group, they're parent and subsidiary. So there is a counteraction potentially that needs to be made to disallow the expense in the UK company, but only to the extent that it exceeds the income of the subsidiary, which is taxable in both jurisdictions. Because if the UK sub has been checked open, then its third-party revenues will be taxable in the UK, and they'll also be taxable in America, because the revenues of the UK sub are treated as the revenues of the American sub for American tax purposes. Well, if you're being taxed on the revenue twice, then there shouldn't be any disallowance because you happen to get this sort of deduction in the UK, which isn't taxed in America. That income that's taxed in both jurisdictions is known as dual inclusion income. And dual inclusion income stops you getting a disallowance. It's defined as ordinary income. That means taxable income, okay, taxable income, which arises both for the hybrid payer, that is the UK sub, and an investor in the hybrid payer, that's the American parent company. It doesn't include CFC deemed income, because that isn't proper income at all. It just gives CFCs just give rise to a tax charge, if at all. And in this scenario, it might be that this is the first year in which the subsidiary has been in existence. And it might be that the subsidiary is in its development stage. It's preparing to earn revenue, but it hasn't earned any revenue yet. So maybe it doesn't have any income, which is taxable, any revenue, which is taxable. So in which case it will have a disallowance under these rules. But this chapter of the legislation provides that if there is a disallowance of the subsidiary's expense, that can be carried forward. It's not permanently disallowed. It gets carried forward and it will be deductible in a future period if the subsidiary gets a source of dual inclusion income in a later period. So let's say that the expense at stake here is 100 grand. Okay, disallowed this year. If next year the subsidiary starts generating third-party revenues and it earns revenue of $1 million and has expenses of 800 grand, then the revenue of $1 million is taxable both in the UK and America. So that is dual inclusion income. Even if the whole of the 800,000 expense was an intercompany expense with the parent, so it would be a potential deduction non-inclusion mismatch because it wouldn't be taxed in America if it's intra-group, that still leaves the company with 200 grand of revenue still taxable in both jurisdictions, which isn't needed to cover that 800 grand. So the subsidiary could then allow in the second year the 100 grand of expense that was disallowed in the first year. So in this particular area, you don't lose the disallowance. It's a deferral rather than a permanent disallowance of the expense. Now, back in 2021, although not retrospectively, it is in principle possible that if there is a UK 75% group owned by an American parent, that if the company that has this disallowance doesn't have a dual inclusion income, under certain conditions, if there's another group company in the UK that does have dual inclusion income, and it doesn't need that dual inclusion income because it doesn't have a disallowance under the hybrid rules, that it can surrender all or part of that income to the company that needs it to avoid a disallowance. But that's subject to certain conditions, the most important of which is that the company, the claimant company, company B it's called in the legislation, the claimant company can only claim surplus dual inclusion income from a surrendering company in the same 75% UK group, if it has ordinary income, which is taxable revenue for the same period, that is not dual inclusion income. Because if company B had dual inclusion income, then it would have avoided a disallowance anyway on its otherwise mismatch payment. And therefore, the income it has to have has to be non-dual inclusion income. So it mustn't represent revenue which is taxable in more than one jurisdiction. Well, therefore, it can only represent revenue taxable in one jurisdiction, presumably the UK. And therefore, in the context of what we're talking about here, it would seem that company B can only claim dual inclusion income from another group company if it itself has revenue which it generates with other group companies that are covered by this check the box election. Because that would be revenue taxable on that company, but in the group accounts in America, for group tax purposes, it would be netted down to zero. So this non-dual inclusion income is intra-group income. It's revenue earned with other group companies. And if you don't have any of it, you can't claim any surplus dual inclusion income of another group company. So in our example earlier, we said that if that's the first year of operation of that subsidiary and it doesn't have any income at all, well, then it has no ordinary income. So even if there's another company with millions and millions of pounds of third-party revenues, taxable both in the UK and America, that subsidiary still can't claim any of that income because it itself doesn't have any taxable income, let alone income that isn't dual inclusion income. It has no taxable income at all. And just to finish with this example, I think, let's assume that you have a client group in the UK. So you look after UK sub 1. UK sub 1 has a subsidiary, UK sub 2. UK sub 2 makes great operating profits. There's a check the box election in place. So they're both transparent for American tax purposes. The UK sub incurs £100 million of interest on this loan at market rates with its American parent. That ordinarily is deductible for the UK sub 1, but it isn't taxable in America. Sub 2 has massive operating profits, massive operating profits. So it's got huge amounts of revenue and huge amounts of operating profits from third-party trading. And with the profit it makes, it pays dividends to UK sub 1 so that UK sub 1 can meet its loan repayments schedule. So those dividends, of course, are not deductible for the subsidiary paying them, and they're not taxable on the UK sub receiving them. Which means that UK sub 1, although it has a whole shed load of dividend income, doesn't have any ordinary income. None of that income is taxable. And therefore, the 100 million expense which it incurs, which isn't taxable in America because it's an intra-group expense, and there's a check the box election in place, that 100 million will be disallowed, despite the fact that UK sub 2 is generating huge amounts of third-party revenues. This structure is disastrous from a hybrid mismatch perspective. What they might want to consider doing is reorganizing so that they transfer the trade of UK sub 2 to UK sub 1. If they hive off the trade out of sub 2 and into sub 1, then sub 1 will now create third-party revenues itself, which will be both taxable in the UK and America. And now the mismatch amount of 100 million interest should be deductible because there'll be more than £100 million of revenues being taxed in both the UK and America for UK sub 1. The only thing just to be careful of, and we'll finish with this, is that if the reason why we are hiving off the trade from sub 2 to sub 1 is with a main purpose of avoiding this mismatch, then there is legislation within the hybrid mismatch part, chapter 12A, I think it is, which says that if you do something in order to mitigate what would otherwise be a mismatch amount, that step can be ignored. So we'd have to come up with an overwhelming commercial imperative for why we want to transfer the trade into sub 1. So that if there was a tax saving motivation, which there clearly is, it wouldn't be a main purpose of what we're doing. We could argue that we're just rationalizing the group because there's no point in having sub 1 and sub 2 separately. But please understand that this arrangement, as it currently stands, is woefully ineffective. And it means that there will be a £100 million disallowance for UK sub 1 every year while this continues. Okay, well, we have run over our midday official finishing time. As I said, we could spend 6 hours on hybrid mismatches, but I'm not sure they're relevant to everybody on the call by any means. If there's enough people who deal with this area, it might warrant having a separate session that focuses just on this one topic. But I just wanted to give you a heads up that this legislation exists and that it can bite, especially where you are acting for UK subs of American groups, but it can also bite if you're acting for UK branches of foreign groups as well, for the same basic reasons as this. Okay, listen, we'll finish at this stage. I hope that refresher and update has been useful. There are obviously an infinite number, well, finite, but broadly infinite number of corporation tax issues we could discuss if we had an infinite amount of time to do so. But I've tried to focus on things I think would be most relevant to you with the clients that you work with. So I hope it was useful. I hope you enjoyed it. And I'll look forward to speaking to you again at some point in the not too distant future. So have a good afternoon and have a lovely weekend.